Welcome to the Medfaber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Medfaber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got an amazing show today. Our returning guest is macro expert Felix Zulauf, founder of Zulauf Consulting. He was previously the global strategist for UBS, later ran his own asset management firm. Felix, welcome back to the show.
Thank you, Meb. It's always a pleasure. Thank you for having me.
One of my favorite things about markets is it's always challenging. It's never a dull day. And we love to talk about how, they're the great humiliator. I wrote an article earlier this year called The Bear Market and Diversification, talking about how the S&P has just stomped everything in sight. And you and I talked last year, and we were already bemoaning the concentration and how the S&P is just a locomotive that is just smashing everything. And here we are a year later, and that sucker's up another 25%. Give us a view. What do you think is going on in the world today? How we look?
And the concentration is even getting worse. 73% of the world's equity market cap is now in the US. And indexing is the way people go these days. So if everyone, everywhere out in the world invests in the world index, 73% of his money goes into the US. And out of those 73%, probably more than 1/3, close to half, goes into 10 stocks. And that is a fantastic concentration we have never seen before. And that's great as long as it goes up. When it reverses, it will be ugly, because then you have the concentration working against you. I don't know when we hit that point, but when we do hit it, it will not be pleasant, that's for sure. So I'm concerned that sometimes in 25, liquidity that has been plentiful over the last 2 years will begin to dry up, and that's when market bubbles break. And I'm concerned about that. I do not know exactly how this will work out, but I'm prepared for it, and I'm waiting for it. And I think it all feels like it's late stage. The valuation is historical. It is close to the historic highs, or depending on what yardstick you take, it could be even the highest. It's a heavy concentration. It is a credit boom that is going on. A lot of the boom is taking place in markets that are hidden, that are private markets, not public markets. And you see some of the anecdotal evidence popping up that you usually see late in the bull cycle, like the famous bear turning bullish, something like that. And I'm waiting for more of those news to get a grip on it, because you cannot call the turn based on fundamentals alone. We know the fundamentals are there. That is later stage of the cycle, but that later stage of the cycle can continue to be postponed and postponed and postponed. So I think we just collect more anecdotal data and evidence of the late stage and are waiting for the technicals to show us what's going on. In recent weeks, the breadth statistics have been deteriorating. It's probably too early to call this a major top, but it's beginning. During 2024, you saw that one market after the other was beginning to lag and falling behind, and that's another indication of a late cycle phenomenon when the focus of the money is on lesser and lesser, fewer and fewer instruments. And so we are in the late cycle, but I cannot tell you far ahead when it will turn.
We're recording this about a week before Christmas. And as you kind of thoughtfully mentioned about valuations, in my opinion, when you look at valuations, when things are crazy, both to the high side or the low side, it usually doesn't matter which indicator you use. They usually all say the same thing, just to varying degrees. And so I challenge listeners, you can't find a valuation metric on the broad market cap weighted US stock market that says stocks are cheap, right? They all say they're expensive, and usually it's like 90 to 99 percentile. But as an example, the one we often talk about because it's discussed a lot in the media is the 10-year P ratio, the CAPE ratio, which is knocking on 40. And we did a study many years ago where we had looked at CAPE ratios of all the countries in the world where you could find data going back 30, 50 years, and in some countries back 100. And PIMCO actually followed up on this research, but we said when it goes above 40, so to me, that's true bubble territory above 40, and so which has only happened once in the US in history, which was late 90s. But on the average historical 5 to 10 year returns across countries has been negative, but never in once has a country in that data set met the historical 10-year returns that were even average, right? So in every instance of those 20 odd samples, they were all below average. So that's a pretty decent data set. Now on the flip side, we said, what about happens when it gets below 7? So true blood on the streets, everything looks terrible. PIMCO said returns historically in the next 5 years was above 20%. So oddly enough, right now, we don't have either. We have some that are close on both sides. US is close. India is right at 40, I think, pretty close. And then on the flip side, you got Colombia, Turkey, Poland, Brazil, Hungary, Austria, China, all around that sort of 8 to 10 range, but getting up there, no matter which way you look at it.
It's even worse when you look at the fundamentals. I just looked at some of the data and saw that in the third quarter, the Magnificent Seven were up in earnings 18% or so, and the 493% were up 0.1%. That's such a difference. That's dramatic. Or companies from 2,000 to 3,000 smallest in the Russell 3000, 2,000 to 3,000, 1,000 companies, more than 50% of them are loss-making. So it's not such a widespread prosperity, and therefore the concentration is somewhat fundamentally based. But what starts out for a good thing, eventually when it goes to an extreme, becomes a bad thing. And I think we are on the way to that. And I think 25 will bring us a reversal, because the liquidity that was pushed into the market came out of the reverse repurchase agreements. Those were about $2 trillion. And we are down in the very low numbers, 300 billion or something like that. There could be a little bit coming from the general account of the Treasury. But other than that, you really needed the QE or the Fed going bonanza. And with growth being at 3.3%, according to the Atlanta Fed in the fourth quarter, based on released indicators so far, it's very tough to see that. So therefore, what we are in is we are in a situation where liquidity continues to grow, but I think it begins to grow at a lesser and lesser rate. And that's when the bubbles become dangerous. So I think at some point in 25, it will burst.
As you look at the economy here, and then we'll kind of hop around the world and look at other asset classes, but no one ever knows what the catalyst is going to be. But there's a few economic topics that tend to be in the word cloud right now. There's tariffs, of course. Everyone is talking about in the news, DOGE committee and efficiency and cutting a lot of government fat. But part of the challenge is cutting a bunch of government fat is that was some real spending that went on somewhere. How do you think about kind of the economy, any factors within the U.S. That might prove problematic for this epic stock market run?
Well, on the positive side, first, we have the unique situation for the first time in modern history and for the only country that I'm aware of that labor supply has fallen below labor demand. That's unique. That has never happened before. And this keeps employment situation and the income situation relatively steady and stable. And that has probably aborted many of the recession pointing indicators as not being valid. That's why so many indicators have been wrong. So we have, of course, the employment situation is softening. I see that also, but we are not at the point where supply falls below demand. And once we hit that point, sometimes in 25, then the economy could, of course, weaken, and weaken more than many expect, because then all of the restrictive policies of the past could really show up. The other thing is, as you already mentioned, Doge, they will not cut out 2 trillion, as Musk said at the beginning. He's down to 500 billion. 500 billion represents approximately close to 2% of GDP. 2% of GDP that would be lacking, would go away, evaporate, because one guy's expenditures are another guy's income. And so it's gone. And what would be good longer term for structural reasons would be quite bad in the short term, because it hurts. You lose growth. The other thing that I'm concerned about is trade. Trade will not be so easy to solve as many think. Many believe that the trading situation with tariffs, Trump uses this as a stick for negotiation reasons, but he will not stick to it. I'm not so sure. The situation is pretty ugly, because when you look at a trade, this is usually manufactured goods. And when you look at employment in percentage in manufacturing, in percentage of total employment, this is relatively low around the world. So trade will not make such a difference. I think if Trump believes that he can move a few percentage points of the manufacturing capacity from China to the US, he may be wrong. That may not work that way. 1/3 of global manufacturing capacity is now in China, and the world depends on China. And if we make products more expensive, tariff is a tax, then somebody has to pay for it, either the consumer with higher prices or the producer with lower prices. So there is a tax. And taxing and tariffs do not lead to prosperity. Historically, they have led to a different outcome, just the opposite. And the tariffs that Trump is talking about, 10% for everyone and 60% for the Chinese, when you look at that, then you are in the period, those are tariffs that were applied in the period from 1900 to 1945, after World War II. If he does only half of what he said, then you are in the period from the beginning of World War I to the end of World War II. When you look at those periods, they have not been very pleasant. Aside from the wars, they were very difficult, nasty economic situations. Of course, we don't have the gold standard these days. We have a fiat currency situation. So I'm not suggesting we go into the 1930s, but I'm suggesting that those are the two risks, the Doge cuts and the trade that cuts out maybe 1% or so of the US. And then the other guys will not sit tight and do nothing. They will retaliate. So those tariffs go up as well. And then you are in the midst of a trade war, and a trade war could escalate as a political confrontation, could escalate in a military confrontation. So we do not know where we will end up with. I think we will sail through some rough water in 25, And I do not believe that we will have a straight up market as we had in 23 and 24, but I think we will most likely see wild swings in the market that could be part of a cyclical top building process. And the way I look at the technical situation, it looks like we could build a medium-term top early in the year, in the first quarter, and then have a decline. I do not know how deep it will be. And then another run up, usually with more divergences, technically speaking, to higher highs, and that should be it. So this is how I figure 25 could evolve.
Well, if you listen to the surveys, the most recent one that was making the rounds was that we had the highest ever when they asked people, do you think the stock market will be up in the next year? Highest ever reading where people said, absolutely, right? Some of the sentiment surveys aren't too crazy bullish, but that one in particular, for some reason, just went vertical on people thinking that there's only one path at this point. There's no more declines, Felix. That's not part of this anymore, it feels like.
It's a guaranteed savings account, right? The stock market and cryptos are guaranteed savings accounts, and the guarantor is the Fed.
Yeah. Well, you and I chatted last year a little bit about all sorts of topics, but fixed income and currencies was one. I was joking because I said, we talked about the yen, and I said, hey, look, I just need this to hang out 150, 160 for a while because I got a few trips to Japan. But looking at fixed income markets, looking at currency markets, what are your thoughts in general?
First of all, I believe we are late in the cyclical decline of inflation rates. And I do believe that the U.S. has a serious inflation problem. I come to the U.S. for 50 years, and it's the first time that the comparable meal in a comparable restaurant costs more in Florida than in Switzerland. First time. And Switzerland is the most expensive place in Europe. So I think there is a problem. I have a residence in Florida, and I see how the costs are going up. And I calculated the costs for next year. They are up the running costs are up almost 30% versus 24. Friends of mine show me the insurance, healthcare insurance. Someone showed me the bill without any changes in the contract, up 90%. So I think this is insane. This is insane, and the average Joe is lost. And inflation was the number one problem that led to the political change, to the new administration. So I think there is an inflation problem, and Trump should focus on inflation and bringing that down. And I think deregulation is a good thing, but if he starts deregulating with the financial industry and the financial industry leverages up more, then it's all a waste in the short run. I think he should really look in the industrial side and in the government side in terms of regulation and cut out a lot of nonsensical rules and regulations. That would be very good. He wants to do supply side economics, meaning low taxes. He cannot go any lower in corporate taxes. When you look at the historical chart of corporate taxes, tax rates, we are down at the bottom. You cannot go any lower, because if you go any lower, you lose a lot of income, and then you have an even bigger financing problem for the government. And the government has a structural expenditure problem. Probably 80 or 75% of the expenditures are legislated anyway, so it's difficult to really cut back. And we are running a deficit of 6 to 7%. And if Trump's plan goes into effect, the deficit will probably first grow bigger, not smaller. And that leads me to the situation that we could face at some point in 25, the trust moment in the US bond market. So the politicians, the Congress will probably not restrict him to the degree that they could because of the majority, Republicans, but I think the bond market will discipline Trump. And disciplining the government is by interest rates going higher, and they shoot up. When Truss came in the UK, Truss came with a program, very pro-growth program in a situation of a large deficit. Bond yields went up 150 basis points. And we could see something like that sometimes next year. So I think there is a risk out there. On the upside for the present time, I see 5% for 10-year treasuries, and the downside is probably 360. When we moved from 0.5% in 2020 to 5% last year, I think it was in October or so, that was the first upcycle in yields in a secular uptrend, in a new secular uptrend. And I think what we have seen so far from 5% down is just a correction to the previous uptrend. And I think that correction will stay within the limits of 3% to 5%, not lower than that. And from there, in the next cycle, we go higher and we will break 5%. And if they try to prevent that from happening by intervening, then you are facing a very inflationary monetary policy, and inflation will go much higher in 26, 27, 28. That's how I see the interest rate and fixed income situation. The Fed is cutting interest rates. I think it is cutting rates to bring the Fed funds rate down to the 2-year rate or something like that. It's not an aggressive cutting, but he does it in an environment where there are no fundamental reasons to do it. And that's not a good sign for the bond market. The bond market doesn't like that. Bond investors are afraid of, in this fiat currency system, that the central banks are staying too easy for too long all the time. It's an asymmetric policy they apply, and therefore the victim is bonds. And I think that will show up at some point next year with such a situation as I described. In the currency market, it's a little bit different. It really depends what happens in the world economy. When you look outside of the US, the world economy is not doing well. China is trapped in a deflationary situation and will not come out of it. They will only apply the bazooka stimulus when the world economy turns really dire and the US economy sours also. They will not go before that because they are afraid of the currency going down too much. And that could lead to a temporary inflation spike, and that could lead to social problems, etc.
Well, you've seen this crazy chart of Chinese bond yields and Japanese bond yields. It's like the reverse alligator chart, right? It's where these Chinese bond yields have come down. And it's one of those charts where you look at, and it's such a, in my mind, not a regime shift, but just it's so clear, like wow, what a big change you've seen going on this chart over the past 10, 20 years.
Yeah, they are at new lows on the 10 years. And at short rates are also declining. The problem is they cannot really go below 1% in short rates. If they go below 1%, the savers withdraw their money from the banking system. And that's a big problem. And therefore, that would create a funding problem on top of an already existing funding problem there is, because the banks are undercapitalized in view of all the potential non-performing loans out there. So this is a big problem, and therefore I think China will disappoint. The US consumer and the Chinese consumer are just juxtaposed. And the US consumer has a strong balance sheet because house prices are going up, stock prices are going up, and the Chinese consumer has 2/3 of his savings in real estate, and the real estate is going down. So that's why he's not spending. He's cautious. He's holding back. And that's the situation with China that I do not really see changing. And Europe is a little bit better, but not by much. Europe is in a structural recession, stagnation, and will probably remain so. Europe is over-regulated, and they have killed the automobile industry due to regulation. The energy situation in some of the countries like Germany is, but not just Germany, some others also, is very dire because energy prices have gone up, and energy is basically economic activity transformed out of energy. So if energy prices go up that factor by 2 or 3, as we have seen, you price yourself out of the global competitive situation. And that has happened to Europe. And the consumer, the European consumer, is in relatively good shape. He has a lot of savings. The employment situation is not as strong as in the US, and it keeps deteriorating. There are a lot of firings going on because bankruptcies are going up and things like that. And all we need a new program in Europe. Europe needs that the EU becomes the world champion of deregulation instead of regulation. I don't see that happening, unfortunately. And I think Europe should get together with Trump and the Russians and try to make peace with Russia and normalize the relationship and re-enter trade and getting cheaper energy, and that would be very helpful. But I don't see that happening either. Maybe there is a solution to the war in Ukraine next year. It won't be that easy because Russia wants some guarantees, which the US cannot really give, and it may drag on for a while longer. But those are the things that are necessary, and I don't see them happening in 24. That means that the U.S. is the best guy in the ugly store, and is doing very well, and all the capital of the world is moving into the U.S. And if this continued, in a new world of nationalism and rising protectionism, there may be some point of time when the people say, well, we need our capital at home. Why don't we introduce regulations to bring the capital home? We do not know whether we will see that or not, but that's a risk outstanding. And I think you already see something going on in Japan. The Japanese central bank is the only central bank talking about hiking rates, where all the others are talking about cutting rates. And the dollar yen has gone from below 80 to 160 in the last 12 years. Purchasing power parity is 88, just to remind you. So we are far below purchasing power parity in the yen. And obviously, I wouldn't like to be Japan's prime minister facing Donald Trump in talks about trade. It's obvious. So they are going to try to strengthen the yen. And this may have important consequences for liquidity, because liquidity was also generated in the world by the carry trade, by funding investments in the financial markets as well as in the real economy by using the yen. Borrowing yen, which was low interest rates, 1% or whatever, and the currency going down every day for over 10 years. So that was credit creation process going on. Now, I think we have hit the high at 162, went down to 140, bounced back to 156. We are now 154 or so. We may trade here a little bit longer into January. And when it rolls over below 162, which I expect in early 2025, then I think we have the next medium-term decline, and that decline could go below 140, because instead of using the yen as a funding currency, everybody has to run for cover. And the yen has a history of having very fast and powerful moves at times. I have traded the yen for very long, and I'm waiting for that to happen. So if that happens, it will probably mean that global liquidity dries up from that angle. And when you look at the neatest correlation of the Nasdaq 100 is really when you take Nasdaq 100 earnings yield, which is the reciprocal of the PE ratio, and you compare it to the Japanese 10-year real yield, JGBs. And those are in lockstep in the last 2 years. And if real bond yields, JGBs in Japan, go higher, it would mean that earnings yields for the Nasdaq would also go higher, which would mean PEs goes down. So I think we are in for some problems from that angle sometimes early in the year.
Well, the yen, certainly on a valuation basis, as mentioned, it's definitely cheap. But these things, like on the purchasing power, tend to work its way out. At least on my dad's soccer team, inflation complaining in the U.S., definitely the beer indicator is high. As you mentioned, it just feels like the thing people forget about inflation is that even though it seems like it's back down to lower levels, the fact that it was at high levels for a couple years means the plateau, it doesn't go back down to where you were, which I think was what people kind of assume, like you permanently move up.
It just continues to move higher, but at a slower rate than before. But the level is important, and the level is hurting, and the average Joe is getting hurt. Of course, for the stock market and for the economy, it may not be that important because the lower 50% represent about 15% of consumer spending, not more than that. So the economy is really a prisoner of the stock market and the crypto market, because if those prices sink, go down 20% or so, then all of a sudden you see savings rate going up and spending going down, because then that would weaken the balance sheet of the consumer. And I think many of the people who are in some of those games, in the tech stocks and in crypto tokens, etc., they have never seen a real bear market before. And I could see that this could be a shock when it happens. It could be a shock. And I do believe that you should analyze the market because the market drives the economy and not the other way around.
One of the big topics we did last year was gold. And gold is an interesting asset that, we certainly believe deserves its place in a portfolio. Most investors we talk to, most American investors usually don't have much. If you're Aussie, Indian, Chinese, Canadian, maybe, but many investors don't have much. But here's a fun stat for you, Felix, because I was scratching my head earlier this summer, maybe it was this fall, and you saw that both stocks, US stocks and gold were up big. And I said, it doesn't feel like that normally happens together. So I looked up and I said, how many times, and I think I went back 100 years, but who knows? And I said, when gold and the S&P were both up 25% in a calendar year, and it's actually never happened before. So I said, this is somewhat of a weird, gold's like your crazy cousin. The correlations are kind of who knows what's going to show up right at the Christmas party. But talk to us a little bit about the case for gold. It's sitting at all-time highs. And then also, does this seem weird to you that both of them are having kind of a monster year? Because it's, at least as far as the stats go, pretty rare.
Yes, and some of the correlations have also broken down. And that's why most Western investors missed the move in gold, because they were waiting for a weaker dollar to buy gold, and they were waiting for real interest rates going lower for gold, and that didn't happen, and gold went up. And why did gold go up? Gold went up because some of the central banks, particularly the BRICS central banks, that are not close friends of the US or the Western nations, they thought they need more diversification. They cannot store their reserves in the US dollar any longer because the US dollar has been misused as a political weapon. And I think the big buying of those central banks was really behind the big push up. They stopped then at some point, and then the Western investors came in, trend following, and they bought up to the peak. And China last week bought a little bit gold again, so they are back in the market with small amounts, as far as I can see, small amounts. And I think gold must digest the previous run up. And my range is 2,800, 2,400. So I think 2,800-ish or so is the upper level for the time being, and 2,400 is the lower level. And I think over the next few months, we will probably see gold dropping into the lower end of the range. And if it does, which I firmly believe, then I think it's a great buying opportunity again, because the long-term story is that we are in a situation where we don't have enough growth in the world economy. The demographic situation in the industrialized world is worsening, keeps deteriorating further. Central bank policy, monetary stimulus, and fiscal stimulus leads to more debt and more fiat currencies, and therefore that's the way we go. And the next calamity will bring on the next big stimulus, whenever that will be, maybe in late 25 or 26, and then we go again. And we debase the currencies as long as we can, and we will try to keep bond yields down at levels that does not hurt the economy too much. And then we go into yield curve control in the next few years, and we put on a very inflationary policy. And I think this is the case for gold, because gold is money. Dollars, euros, yuan, yen, what have you, that's credit. That's not money. That's IOUs, you know. That's the difference. Gold is money. Gold is a stable anchor, probably similar to, some would say, Bitcoin. Maybe. We have no experience what the value of Bitcoin would be. In gold, we know gold has usually the price of a very expensive suit. So we have some experience over a long period of time. And I think gold will eventually go above 3,000 and maybe much higher later on. So I'm constructive on gold longer term, bullish on gold longer term, but I think the next few months we will have to digest the recent run-up.
I got to ask, because, everyone listening wants to know. They say, well, Felix, or have you adopted the young man's gold yet? The digital gold that is also hitting new highs. We're over 100,000 as we speak. By the time this publishes, who knows? It could be 150,000 or back down to 50. This thing, I did a fun podcast last week with a few quants, and they were showing gold versus Bitcoin, but they volatility adjusted them. And they said it's a really interesting comparison because the Bitcoin volatility. And I said, by the way, out of curiosity, what is the levered amount that you need to get the gold to Bitcoin volatility? And it was 5.7. So, the gold already, like, you got to get it up to that 80 vol of Bitcoin. So we're going to ignore Fartcoin and all the other, crazy thousands of cryptos that are out there that are going to go the way of the dodo bird. But Bitcoin has certainly found a place. How are you thinking about it these days?
It is certainly not usable for money in everyday's life, but it could be a store of value. The problem is I cannot value it. I do not know what the true value is. I do not know how to do it. Maybe someone else can do it. I can't. And that's why I have not bought into the cryptos. However, when it fell below 20,000, I wrote to my subscribers and said, if you ever thought about buying Bitcoins below 20,000, here is the time to do it. And I should have listened to myself and bought some and put it aside. but the volatility is mind-boggling, and it's great when it's on the upside. It's horrible when it's on the downside. My targets were first 70,000, and when we break 70, we go to 115 to 130. And I think that is the move we are in. And I think the corrections in between will be relatively small, and we go to that level. And then, if I'm correct in my analysis, and I use liquidity on one side as a driving engine and technical analysis on the other side to make some calculations and trend and momentum analysis, then I think we are up for one of those big corrections again, and they are usually up to 80%. So that could be dramatic. I do not know when it comes, but it could be from a 25 top to a 26 low or something like that.
Part of the fun things catching up with you on these hopefully now annual chats is, talking about what's in the news, but what also is not in the news. And there's certain topics that over the years everyone is talking about all day long, and there's other times when it's just kind of out of mind. One that I was thinking about also in the commodity world is oil isn't getting a whole lot of discussion. At least I don't feel like there's a whole lot of discussion going on about oil. And some commodities, as they always do, have gone haywire this year. We had cocoa going loony earlier in the year and all sorts of stuff going on. But, as you think about commodities, as someone who's talked about not just gold, but others, anything particularly interesting going on in that space? It could be oil, it could be any of the other ones too.
On oil, I think the physical market is very well supplied, and you saw that by gold not really blinking when the Middle East war broke out and things like that. We have about 7 million barrels of spare capacity by OPEC at the present time. So that gives you a cushion zone. And my hunch is that we could still go a little bit lower, but the geopolitical risk is not gone. I think the war in the Middle East will come back and will heat up with Iran. And then it could get ugly because Iran could close the Straits of Hormuz, and then we have a much higher oil price. So I think my downside is about low $60 in oil, and my indicators tell me that sometimes in 25 it should turn up, it should reverse. And that's also true for the commodity complex as such, the Bloomberg Commodity Index, for instance. I think the metals look weakish, and I think base metals will decline first some more because 50% of the consumption goes to China, and China is not in a condition that is robust. It's very soft, and therefore I think we have downside pressure in things like copper and aluminum. The copper inventories are on the very high side, and therefore it's too early to buy them. Where I think it could be fun next year in 25 and 26 is in agricultural commodities. We have slowly but surely declining stock of wheat and corn and soybeans. And the way I look at the weather picture, it is due to move into a dry period next year. So if we have a bad harvest, and the potential is there based on what I see in the weather conditions, it is possible that all of a sudden those prices that are very depressed and have declined for the last 2 years could have a big run to the upside. As you now see with cocoa is really due to an insect that is hurting the harvest. A little bit similar to coffee, where you have another run-up, and coffee and cocoa and the meats, cattle are the only 3 sectors that are really doing well in the commodity environment. The rest, and gold, the rest is really not doing well. So we need aggressive stimulation. And, the European situation moves to a point where they probably are pushed and forced to do something and do some infrastructure project or whatever. They certainly will invest more in defense. There may be some help on the Chinese side, even if it's only a bounce like we saw in Japan in 96, I think it was. You have a run for a year or so in the economy. That could start sometimes next year. I think at that point, you would see a weakening US dollar because the US economy is not doing so well. Trump wants to push for growth. And then he forces the Fed to become very easy, and the Fed begins to stimulate, and then the dollar turns down.
Felix, you mentioned in one of your pieces recently, we only have you for a few more minutes, so I love this quote, and I wanted to hear you expand on it a little bit. But at one point in an interview, you said, "I don't like relative performance because I cannot eat relative bread." Talk to me about what you mean by that and how that applies to how people should think about their portfolios going into the new year.
Actually, the quote is George Soros said that to me in my younger years. And I have always been, from the very early days on, I have always been an absolute performer. I didn't care so much about relative performance, except for the professionally managed portfolios for mutual funds and hedge funds that I did. I was in the performance rate, and relative performance was important. But it was, to me, it was less important on the way down. It was more important on the way up, because on the way down, I don't want to lose. I don't want to lose, and if possible, I want to make money. And in all bear markets, in all bear cycles from 73 onwards, I have made money. And when others lost money, I may have not made as much in the later stage of the cycle in the bull runs, because I'm a cautious guy, and I grew up having nothing, and I had to build up my wealth. And once you build it up through hard work, you don't want to lose it in a dumb way. So managing the risk is very important. And I think 25 will be a year where investors should change the focus from managing the opportunity to managing the risk on the portfolio. I think that's very important.
And if you look at even, doesn't feel that too long ago, 2022, a lot of investors feel warm and cozy when they have certain things like US stocks and bonds. But as we learned, again, those type of investments don't always zig and zag. And then sometimes, you get a pretty bad experience if you count on something like that happening, which is not something as a lesson of history, right? As these correlations can move over time. And for the early part of the 20th century, stocks and bonds usually didn't help when times went south.
There could be one big move in bonds next year. If there is some sort of calamity, I could see that in the very oversold bond market from a cyclical perspective, there could be one medium-term move for a few months, but that will be it. And that will be it for a long time, I guess.
Felix, you got to give a New Year's resolution to investors, meaning like a good takeaway on how to think about markets in 2025 or how to behave. What's one thing that they as they sip on their champagne at year end should really reflect on for the new year?
Well, as I said, the opportunity management was the right thing to focus on over the last 2 years. I think it's getting late in the cycle, and when it's late in the cycle and your surrounding is getting more and more optimistic, don't forget that you should turn the focus more on managing the risk.
Well said. Felix, happy holidays. It's been a blessing to have you again, and wishing you and yours a wonderful New Year's.
Thank you very much, Mav. It's been a great pleasure as always, and happy holidays and the best for the new year. Thank you very much.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast.
If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.